Take a moment. Look around the room you're sitting in right now. Look at your smartphone. Look at your laptop. Look at the lights above your head. Look at the switches on the wall. Look at the invisible signals moving through the air around you. You are looking at the modern world. You are looking at one of the greatest engineering miracles in human history. A civilization that communicates instantly across continents, processes information at the speed of light, and runs on devices smaller than the human hand. But here is the uncomfortable truth almost no one talks about. None of this exists without one specific element. It is not gold, it is not oil, it is not lithium, it is not even copper. It is element 47 on the periodic table, silver. For thousands of years, humanity treated silver as money. We minted it, we stored it, we fought wars over it. Empires rose and fell based on access to silver. But something changed in the last century. Silver stopped being just a store of value. It quietly transformed into the essential DNA of the technological age. Without silver, satellites struggle to function. Without silver, solar panels lose efficiency. Without silver, advanced electronics fail. Without silver, the digital world as we know it simply does not work. Every smartphone, every data center, every electric vehicle, every military system, every renewable energy grid, all of it depends on silver's unmatched physical properties. And yet, we built our entire civilization on a dangerous assumption. That silver would always be cheap. That silver would always be available. That silver would never run out. What if that assumption is wrong? What if silver is not abundant, but scarce? What if silver is not overvalued, but historically mispriced? What if silver is not just another commodity, but the most strategically critical metal on Earth? Because this is not just a story about price. This is a story about physics, geology, industrial demand, and a supply system that is now approaching a hard limit. This is the story of the silver supply cliff, and it is bigger than 1980. In 1980, silver shocked the world. Prices exploded. Markets panicked, governments intervened, and when the dust settled, the narrative was clear. That was a once-in-a-lifetime event. But what if 1980 was not an anomaly, but a warning? Because what is happening now is fundamentally different. In 1980, silver was still largely treated as money. Industrial demand was limited. Technology was primitive compared to today. Today, silver is no longer optional. It is consumed. And that single word changes everything. Gold is stored. Silver is used and destroyed in the process. Once silver goes into electronics, solar panels, medical equipment, and advanced manufacturing, much of it is never recovered. It is gone, consumed faster than it can be replaced. Here is the reality most investors never hear. Silver supply does not respond to price the way people think it does. Unlike oil, you cannot simply turn on the tap. Unlike gold, silver is rarely mined for its own sake. Over 70% of global silver production comes as a byproduct of mining other metals. Copper, lead, zinc. That means silver supply is not controlled by silver demand. It is controlled by the economics of other metals. Even if silver prices double, even if they triple, silver supply barely moves because miners do not mine silver. They stumble upon it. This is the structural flaw at the heart of the silver market. And it is now colliding with a demand curve that is going vertical. Consider solar energy. Every solar panel requires silver paste for its electrical contacts. There is no substitute that matches silver's conductivity, durability, and efficiency at scale. Governments around the world have committed trillions of dollars to energy transition plans. Solar is not optional, it is policy. And policy does not ask whether silver is available. It assumes it is. Now add electric vehicles. Each EV uses significantly more silver than a traditional internal combustion car. Add charging infrastructure, add grid upgrades, add battery technology. Add defense systems. Add AI data centers. Silver demand is not cyclical anymore. It is structural, permanent, relentless. Now look at the supply side. Global silver mine production has been flat for years. Major discoveries are declining. Ore grades are falling. Mining costs are rising. New silver mines take 10 to 20 years to develop, if they are developed at all. And remember, most silver does not come from silver mines. So even if prices scream higher, supply remains trapped. This is what a supply cliff looks like. Slow, silent, ignored, until it is suddenly unavoidable. There's another layer almost no one talks about. Silver inventories. For decades, the world treated silver as surplus. Governments sold it, vaults drained it. Strategic stockpiles vanished. Silver was cheap, so why hold it? That decision is now coming back with consequences. Above-ground silver stocks are far smaller than people assume, much smaller. And unlike gold, silver stockpiles are not neatly stored in central bank vaults. They are scattered, locked inside products, lost to history. Once they are gone, they are gone. This creates a dangerous illusion. Paper markets suggest abundance. Futures contracts imply liquidity. Prices appear controlled. But physical reality does not negotiate with derivatives. At some point, physical demand meets physical limits. And when that happens, price is no longer the variable that matters. Availability is. This is why the silver story today is not about trading. It is about survival of systems. Silver is not rare in the universe, but usable silver, mined, refined, deliverable, is rare where it matters. And humanity is consuming it faster than nature can replace it. That is the definition of a supply cliff. You don't notice it at first? Then suddenly, there is no floor. This is not a trade alert. This is not a price prediction for next week. This is not hype. This is a structural reality that unfolds over years and then resolves very quickly. To understand what comes next, we need to go deeper. We need to look at geology. We need to look at mining economics. We need to look at why silver behaves differently than every other metal in history. Because once you understand that, you will realize something unsettling. What is coming next is not just bigger than 1980. It is something the modern financial system is not prepared for at all. To understand why the silver supply cliff is real, unavoidable, and irreversible, you have to step away from markets, charts, and price predictions. You have to go deeper. You have to go underground. Because silver's problem is not financial. It is geological. And geology does not care about demand. Most people assume that when prices rise, supply rises with it. That assumption works for some commodities. It does not work for silver. Silver is not like oil, where reserves sit waiting to be tapped. It is not like gold, where higher prices immediately justify new exploration. Silver exists in a very different way. It is scattered, diluted, fragmented across the Earth's crust. Pure silver deposits are rare, extremely rare. Most silver is not found in concentrated high-grade veins that can be economically mined on their own. Instead, silver is usually found in trace amounts, locked inside ore bodies that are mined for other metals: copper, lead, zinc, sometimes gold. Silver is the passenger, not the driver. This single fact changes everything. When demand for oil rises, oil producers increase drilling. When demand for gold rises, gold miners increase exploration. But when demand for silver rises, nothing immediate happens. Because silver production depends on the economics of metals that have nothing to do with silver itself. A copper mine does not expand because silver demand is strong. A zinc mine does not increase output because solar panels need more silver. Silver is trapped inside someone else's business model. That means silver supply is structurally inelastic. It does not respond to price signals. And markets that cannot respond to price signals eventually break. Now add another layer most people never consider: ore grades. Over the past century, the mining industry has already extracted the richest, easiest silver deposits. What remains is lower grade, deeper, more complex, and more expensive to extract. This is not opinion. This is data. Average silver ore grades have been declining for decades. In simple terms, miners must now process far more rock to get the same amount of silver they use to extract easily. More rock means more energy, more water, more chemicals, more labor, more environmental resistance, more capital. All of this raises costs permanently. There is no technological breakthrough that reverses geology. You cannot innovate your way around scarcity. And then there is time. Even if a major silver discovery were made today, which is increasingly unlikely, it would take 10 to 20 years before meaningful production reaches the market. Permits, environmental approvals, infrastructure, financing, construction. Silver does not arrive on schedule just because markets are impatient. Supply is slow. Demand is not. This is why the phrase, "just mine more silver," reveals a complete misunderstanding of reality. You cannot mine what does not exist in concentrated form. You cannot accelerate geology. You cannot compress decades into quarters. And yet global policy, industrial planning, and financial markets all behave as if silver supply is flexible. It is not. It never was. Now consider consumption. Silver is not hoarded the way gold is. Gold is recycled. Gold is stored. Gold is preserved. Silver is consumed, used up, destroyed in function. When silver goes into electronics, it is often used in microscopic amounts, spread thin, fused, and embedded in ways that make recovery uneconomical. The silver in your smartphone will likely never be recycled. The silver in solar panels may not be recovered for decades, if ever. The silver in medical equipment is often disposed of entirely. This is critical because it means silver demand is one way. Once consumed, it exits the system. Gone. Recycling does exist, but it is wildly overstated. Recycling depends on price, concentration, and accessibility. Low concentrations mean low recovery rates. Complex products mean high costs. And many forms of silver use simply do not justify recycling economically. Recycling cannot save the silver market. It can only slow the inevitable. Now zoom out. For decades, governments and institutions treated silver as surplus. Strategic stockpiles were sold, national reserves were liquidated, vaults emptied. Why hold silver when it was cheap, abundant, and obsolete as money? That mindset drained the buffer, the safety margin. The world no longer has large, easily accessible silver stockpiles waiting to be released. Those stocks were consumed, sold, melted, distributed into industry. What remains above ground is far smaller than most models assume. This creates a dangerous illusion. On paper, silver appears plentiful. Futures markets trade massive volumes. Contracts roll endlessly. Liquidity looks infinite. But paper silver is not physical silver. Paper promises do not power solar grids. Derivatives do not conduct electricity. At some point, physical demand meets physical limits, and paper markets cannot fill that gap. History is clear on this point. When physical scarcity collides with paper abundance, the paper market breaks, not the physical one. Delivery fails, spreads explode, confidence collapses. This has happened before, but never under conditions like today. Because today, silver is no longer a luxury metal. It is a strategic material. Energy transition plans depend on it. Defense systems depend on it. Communications infrastructure depends on it. Modern civilization assumes silver availability as a given. That assumption has never been tested at scale. Until now. Another uncomfortable truth: there is no true substitute for silver. Copper is less conductive. Aluminum degrades faster. Synthetic alternatives fail under stress. Silver's unique combination of conductivity, thermal efficiency, and reliability cannot be replicated. Physics sets the limit, not innovation. This is why attempts to thrift silver, reducing usage per unit, only delay the problem. Efficiency gains get overwhelmed by scale, more solar panels, more devices, more data centers, more electrification. Silver demand does not decline, it accelerates. Now consider the geopolitical layer. Silver production is concentrated in a small number of countries. Supply chains are fragile. Political risk is rising. Resource nationalism is returning. Export restrictions, environmental protests, labor disruptions. All of these add volatility to a supply system that already cannot respond. This is not a stable foundation. Markets are forward-looking only when forced to be. Silver has been ignored because it was cheap. That cheapness created complacency, and complacency created vulnerability. When supply constraints finally become visible, the response is never gradual. It is sudden, nonlinear, violent. Not because people panic, but because systems cannot adapt quickly enough. This is why comparing today to 1980 misses the point. In 1980, silver spiked because of monetary fear and speculation. Today, silver faces physical exhaustion. That is a fundamentally different force, one that cannot be reversed by policy, regulation, or market intervention. The silver supply cliff is not a theory. It is a consequence of decades of underinvestment, of geological limits, of industrial dependency, of consumption without replacement, and it is already forming beneath the surface, quietly, relentlessly. To understand what happens when this reality collides with the financial system, when paper silver meets physical limits, we need to examine how silver is priced, traded, and controlled. Because the next phase of this story is where illusion meets constraint, and history shows what happens next. The great silver illusion. Paper promises versus physical reality. To understand why the silver supply cliff will not resolve quietly, you must now look beyond geology and industry. You must look at the mechanism that tells the world what silver is worth. Because the greatest misunderstanding in the silver market is not about scarcity, it is about price. Silver's price does not come from miners. It does not come from manufacturers. It does not come from physical availability. It comes from paper, and that distinction explains everything. The global price of silver is discovered primarily in futures markets, paper contracts, derivatives, promises to deliver silver at some future date. On most trading days, the volume of silver traded on paper markets exceeds actual global mine production by multiples, sometimes by hundreds of times. This should raise an obvious question. How can something be traded in such enormous quantities if it does not physically exist? The answer is simple. Most of it never needs to exist, until someone asks for delivery. Futures markets were originally designed to hedge production and consumption. They were meant to stabilize supply chains. But over time, silver futures evolved into something else entirely. They became a pricing mechanism disconnected from physical reality. Banks trade silver contracts they never intend to deliver. Funds speculate without any exposure to the metal itself. Algorithms move price based on liquidity, not scarcity. Silver is priced as if it were abundant, because paper silver is infinite. Physical silver is not. This creates a profound distortion. When physical demand rises, price does not necessarily rise. When inventories tighten, price can remain suppressed. When shortages appear, markets can ignore them, temporarily, because paper markets absorb pressure until they can't. The system relies on one assumption above all others, that very few participants will ever demand physical delivery at the same time. As long as silver stays cheap and ignored, that assumption holds. But when confidence shifts, the structure becomes unstable because futures markets are not backed by equal amounts of physical metal. They are backed by confidence, and confidence is not a metal. Now consider how silver is treated compared to gold. Gold is explicitly recognized as a monetary asset. Central banks hold it, governments report it, vaults audit it. Silver is treated as a commodity. That classification allows it to be leveraged, rehypothecated, and oversold without the same scrutiny. Silver is financialized, but not protected. This makes it uniquely vulnerable to distortion. 1 ounce of physical silver can have dozens, sometimes hundreds, of paper claims attached to it. Each claim assumes the others will settle in cash. This works until someone refuses, until someone wants metal. History shows what happens when paper claims collide with physical constraints. Delivery delays, rising premiums, backwardation, exchange interventions. Rules change, not to protect the buyer, but to protect the system. This is why silver price behavior often confuses observers. Rising demand does not always raise price. Tightening supply does not always signal stress. The signal is muted, filtered, delayed, but it does not disappear. It accumulates. Eventually, the gap between paper price and physical reality becomes too wide to ignore. This is when the market does not reprice, it restructures. Now consider the role of major institutions. Large banks dominate silver derivatives trading. They provide liquidity. They make markets. They manage exposure. But they also rely on stability. Violent repricing is not in their interest. Neither is physical scarcity. Because a market that demands delivery is a market that reveals imbalance. This is why silver suppression theories persist, not because of conspiracy, but because of structure. A highly leveraged paper market requires price stability to function. When price stability conflicts with physical reality, reality eventually wins, but not before resistance. The most important thing to understand is this. Silver is priced at the margin. A relatively small amount of physical buying, or refusal to sell, can overwhelm the system. Because the system is not designed for mass physical settlement. It is designed for cash flow. Now introduce the next force. Industrial users. Manufacturers do not speculate. They do not trade charts. They do not care about narratives. They care about supply. If silver is unavailable, production stops, contracts fail, deliveries halt, systems break. At that point, price becomes irrelevant. You cannot pay any price for what cannot be delivered. This is where silver differs from almost every other traded asset. It sits at the intersection of monetary history, industrial necessity, financial leverage. That combination is unstable. It always has been. In past cycles, monetary demand drove silver spikes. In the future, industrial demand will drive availability crises. These are not the same. Monetary spikes can fade. Industrial shortages compound. Now add investor psychology. Silver has been dismissed for decades, called boring, called manipulated, called a widowmaker. That dismissal has kept positioning light underowned, underallocated, ignored. This is exactly the condition that precedes violent repricing. Not when everyone is excited, but when no one is prepared. Markets do not move when stories are popular. They move when assumptions break. The assumption that silver will always be available at low cost is embedded everywhere. In energy policy, in manufacturing, in defense planning, in financial models. No contingency exists for silver scarcity, none. When shortages appear, they will not announce themselves politely. They will show up as delays, as premiums, as rationing, as substitution attempts that fail. Only later will price react. This is why silver will not gradually rise like a normal asset. It will remain ignored until audits, until it cannot be. Then it will reprice not as an investment, but as a strategic necessity. History provides a pattern. Every time a metal transitions from monetary to industrial importance, while remaining monetarily relevant, the result is instability. Silver is the last metal where this transition is incomplete, and that makes it dangerous. The silver supply cliff does not require panic, it only requires continuity. Demand continues, supply stagnates, inventories drain, paper claims accumulate. At some point, the system faces a choice, cash settlement or physical truth. That moment is never planned, it is forced. And when it arrives, the response is not orderly, because leverage does not unwind gently. The silver market today resembles a compressed spring, quiet, tight, ignored. Energy is stored, and it does not need a catalyst, only a trigger. To understand how this ends, and why the outcome is not just higher prices, but a fundamental repricing of silver's role in the world, we need to step back into history, because silver has been here before, and it never resolves the same way twice. When reality returns, why silver's endgame is inevitable. To understand how this story ends, you must step outside the present moment. You must step outside daily price movements, market noise, and short-term thinking. Because silver does not resolve its contradictions quietly. It never has. Every monetary system eventually reveals its stress points, not all at once, not evenly, but precisely where assumptions were weakest. For the modern world, silver is one of those weak points, ignored, underpriced, taken for granted, and absolutely essential. Throughout history, silver has played a dual role unmatched by any other metal. It has been money, trusted across cultures, empires, and centuries, and it has been utility, valued for what it does, not just what it represents. Most assets are one or the other. Silver is both. And that is why it never fits comfortably inside financial systems. When silver was abundant relative to demand, it behaved quietly. When silver was scarce, it destabilized economies. This pattern repeats relentlessly across history. In ancient civilizations, silver shortages led to debasement. In medieval Europe, silver flows defined trade routes and power. In the modern era, silver anchored currencies until it became inconvenient. Each time, the outcome was the same. Silver was removed from the system not because it failed, but because it constrained excess. By the mid-20th century, governments made a decision. Silver was too honest, too finite, too limiting. So it was demonetized, sold off, dismissed as an industrial commodity. That decision solved short-term problems and created long-term ones, because silver did not disappear. It migrated from vaults into factories, from coins into circuits, from money into infrastructure. The world did not stop relying on silver. It relied on it more than ever. The difference was this. When silver was money, scarcity forced discipline. When silver became just a commodity, scarcity was ignored. And ignoring scarcity does not eliminate it, it concentrates it. This brings us back to 1980. Most people remember 1980 as a speculative event. They are wrong. 1980 was a stress fracture, a signal. Silver was responding to monetary instability, inflation, and loss of confidence. But industrial demand was still small, technology was still young, supply was still flexible. What happened then was dramatic, but incomplete. Today's environment is fundamentally different. Silver is no longer just responding to monetary pressure. It is responding to physical exhaustion. And physical exhaustion does not reverse. In 1980, governments could intervene, rules could change, markets could be frozen, and silver eventually retreated. And not because the problem was solved, but because time was bought. That time has now been used up. The modern world runs on silver. This is not metaphorical, it is literal. Remove silver and systems fail, energy grids weaken, communications degrade, defense systems suffer, medical technology falters. There is no contingency plan for a silver shortage because no one planned for one. This is what makes the coming resolution different. Silver is no longer optional, it is non-negotiable. When industrial users face shortages, they do not wait for futures prices. They secure supply at any cost. Because the cost of not having silver is existential. This is when price stops behaving like a market variable and starts behaving like a rationing mechanism. This is the moment markets are structurally unprepared for. Paper silver can absorb speculation. It cannot absorb necessity. Once physical silver becomes visibly scarce, several things happen simultaneously. Premiums disconnect from spot prices. Long-term contracts are renegotiated. Smaller buyers are pushed out. Strategic buyers dominate supply. At this stage, silver no longer trades freely. It is allocated. Allocation is not a market event. It is a system response, and it always arrives late. Now consider the broader monetary environment. Debt levels are unprecedented. Currency credibility is fragile. Trust is eroding quietly. In such environments, history shows that tangible assets regain importance, not because people romanticize them, but because systems fail. Gold receives attention. Silver receives disbelief. Until disbelief becomes urgency. Silver's small market size makes it uniquely volatile. It does not take massive capital to overwhelm supply. It takes commitment. Once capital stops trading silver and starts securing it, the character of the market changes permanently. At that point, silver stops being priced against currencies. Currencies are priced against silver. This is subtle, but absolute. This does not require silver to become official money again. It only requires it to become scarce enough that trust shifts. Markets are not philosophical. They are adaptive. The endgame for silver is not a spike. It is a repricing, not driven by speculation, but by necessity. This is why attempts to cap silver prices ultimately fail. They fight physics, they fight geology, they fight industrial reality, and those forces always win. Silver's role as the indispensable metal means it cannot be allowed to disappear, which means it cannot remain cheap indefinitely. Those two conditions cannot coexist. Every decade of underpricing compounds the imbalance. Every year of consumption without replacement narrows the margin. Every policy built on the assumption of abundance increases vulnerability. Eventually, the system adjusts, not gracefully, but decisively. When that happens, Silver will not be rediscovered as an investment opportunity. It will be recognized as what it always was, a foundation. The silver supply cliff is not about fear. It is about arithmetic. Finite supply, growing demand, delayed response. This equation does not need belief, it only needs time. And time has already passed. What comes next will not look like the past. 1980 was loud. The next phase will be structural, longer lasting, more disruptive, more consequential. Silver does not collapse systems, it reveals their limits. In the end, silver's story is not about profit, it is about truth. The truth of scarcity, the truth of dependency, the truth that no civilization escapes physical limits. This is bigger than 1980, because this time, silver is not knocking at the door of the financial system. It is holding up the walls of the real one, and walls do not negotiate. They either hold or they fail.